Hi, everybody. It's Mike DiVita here again. I want to thank you for continuing on with your mortgage education. Today's topic are FHA mortgages. I'd like to explain them to you. If you're in the market for a mortgage like this, I want you to understand the ins and outs. I've talked to a lot of people who buy with this type of product and they have no idea what they actually have done. So I want to explain to you what they are, the characteristics of them, and put a real-time example on the whiteboard. Now, the definition of an FHA mortgage is a government-insured mortgage by the Federal Housing Administration. These mortgages came out after the 30s, after the Great Depression. It was a way for the government to spur the economy by making it easier for people to buy a home after they had some, a financial hardship. Just they're easier to qualify for. So I want to go right into the characteristics of an FHA mortgage compared to a conventional mortgage. The number one, advantage is the low down payment. On a single-family home, it's 3.5% down on an FHA mortgage compared to 5%. And, most people are putting 20% down on a conventional mortgage, but you can get away with 5% on a single family. On a duplex, it's 3.5% down FHA compared to 20% down on the conventional mortgage. On a triplex, it's 3.5% down on FHA compared to 25% down conventional. And on a fourplex, once again, that's still that low 3.5% down FHA compared to 25% down on the conventional. You can see that advantage with that low down payment option. Number two, FHA mortgages have easier credit standards for qualifying. They'll actually go down to a 500 credit score if you put a little bit more down payment, traditionally 10%. And if you want to do that 3.5% low down, it's a 580 minimum credit score. Let's compare that to a conventional mortgage. It's a minimum credit rating of a 620. So that's a pretty huge difference in terms of the credit standards. Number three, FHA mortgages allow for a higher debt to income ratio. Simply put, they're easier to qualify for. They're a lot easier than the conventional. So you might ask yourself, what's the catch here? These FHA mortgages sound amazing. The catch is going back to that definition I talked to you in the beginning of this presentation. These are government-insured loans. There's an insurance policy, and you're paying the premiums on these mortgages in two parts. There's upfront mortgage insurance when you close escrow, and that comes out to 1.75% of the mortgage balance when you close escrow that you have to pay. And number two, there's an annual mortgage insurance premium. It's between 1.3 and 1.55% per year. So let's go right to an example. Let's take a $400,000 purchase. Now let's assume that you're doing a 20% down conventional mortgage. That's $80,000 for the down payment. Now let's compare that to the FHA mortgage. That's 3.5% down. That's only $14,000. The loan amount of the conventional mortgage is going to be $320,000. The loan amount on the FHA is $386,000. Let's go back to that insurance thing we talked about. The upfront insurance on the conventional, zero. The upfront insurance on the FHA is 1.75% of the $386,000. It comes out to $6,755. You don't have to pay that out of pocket though. FHA will allow you to finance it into loan. You can increase the loan amount by that amount. So 386 increases to 392,755. Now, for the purpose of this illustration, let's assume both loans are available at 4%. Once again, not a quote for rates ever, just, let's do it as a point of comparison. The monthly payment on the conventional is $1,527 compared to $1,875 on the FHA. Now, obviously, it's a higher loan amount, and that's why that payment is higher. But there's that monthly mortgage insurance premium that we talked about as well. The second feature of the insurance. It's zero on the conventional because there's no mortgage insurance. It's 1.35% in this scenario. So that comes out to an additional $434.25 that you have to add to that payment. So the $1,875 payment actually bumps up to $2,309 per month. So you pay an additional $782 per month for the FHA loan. And you have to factor in that mortgage insurance payment. So you have that 4% rate we started with, but you're paying 1.35% in the mortgage insurance, which basically, increases the effective rate on that loan to 5.35%. So I don't want you to walk away from this thinking that FHA mortgages are a bad deal. They're actually a really great deal. You know, if you don't have the money for the conventional and maybe you've had some credit issues, it's a great way to get into your first property. And I love the fact that you can get into an investment property, into a multi-unit property with that low down payment. I mean, you can become a homeowner and a real estate investor at the same time, collecting rents from the other units. I love that. And just remember, this doesn't have to be the last mortgage you have. I mean, you can pay down this mortgage and hopefully the property appreciates and maybe you can refinance later on into a conventional mortgage and knock out that mortgage insurance premium. You know, that this could be just the initial tool to get you into your first property. So I'd love to go over any scenario you have about FHA. I'd like to explain it to you completely so you completely understand what you're getting into if you're considering this type of mortgage. And I want to encourage you, if you're buying a house, to check out our California Home Buyers Kit. It's a vital tool to help you understand the buying process, help you understand mortgages, and for you to make informed decisions that you're going to feel really good about when you decide to buy. You can always contact me at 1-800-239-1103. I will answer any question you have about any topic, and send me an email anytime at mike@mycahomeloan.com. Thank you, and make it a great day.